Hello everyone, my name's Susan Oldmeadow Hall and welcome to the Government and Not-for-Profit Financial Reporting Update. Before we start, I'd like to pay our respects to the traditional owners and custodians of the land upon which we find ourselves and pay respect to the traditional elders, past, present and future. I'd like to introduce you to Wayne Basford, who will be running the session with me. Wayne and I are both partners in the IFRS advisory practice at BDO, and we were going to give you a government and not-for-profit financial reporting update dealing with leases and the new revenue standards, and we really thought that was going to be quite a massive exercise in itself, and then coronavirus happened. And so this first session, we're really looking in the first part at the impacts of coronavirus. And I just want to get a feel from everyone on the call or on the broadcast that we've got here today. We're going to put up a polling question. Another thing that you do have is you have the ability to ask questions. And I really encourage you to raise questions because it does make it a bit more interesting and interactive for everyone. And the other part of it is that then you can get real-time answers from us by attending this and asking a question. So I'm going to launch a poll, and the first question that I'll be asking is, do you anticipate that preparation of your 2020 financial report will be more complicated because of COVID? Significantly, to a minor extent, too early to say, or not at all. And because this is government and not-for-profit, we are sort of expecting that there'll be, quite varying answers in terms of how much this has impacted or will impact your financial statements. So if you can answer that question, that would be really appreciated. So the results are coming through, and it really is interesting in terms of how the polling is coming through. I'll just give you another half a minute to answer the question, and then we'll close the results and we can have a discussion on, whether that was an expected outcome. So I've got 75% of people have voted. Okay, you've done a great job. 85% of people have voted, so I'm going to close the poll now. And I'm sharing the results with you. So do you anticipate preparation? Look, when you look at this, 67% of people are saying yes, they believe that there will be a significant impact. So that is quite interesting to see how those results have come through. I'll now hand over to Wayne. Wayne, is that what you expected to see?
Helps if I take my mute off. Unfortunately, yes, Susan, the impact of COVID and how it impacts financial reporting is going to be horribly complicated this season.
But we saw 20% saying they expect a significant impact and 47% to a minor extent. Were you expecting more people to have a significant impact?
It's very difficult to know actually who's on the call. If you're in certain sectors, if you're in the performing arts, if you're in sports and recreation, it's almost cataclysmic of not being able to deliver your services. For other people, being able to access funds, major impacts. Obviously, for most government departments, it's business as normal, apart from more work and struggling to work from home. So it depends on the audience, but so I can understand that on those results. I am a bit surprised with the too early to say. This, and hopefully as we go through this session, we'll look at what people should be talking about. And obviously people on this call are our accountants. This is going to be really big conversations that should be happening between the accountants, the directors, your boards, and your auditors. So, introduce myself and good morning, everybody. There's almost a way I really do not like delivering these two sessions. Myself and Susan are very technical IFRS partners. IFRS was actually written for capital markets. We've got very, very complicated standards. We've got the new leasing standard, AASB 16. We've got a very complex revenue standard, AASB 15. And when normally people ask me, what's the purpose? It's not fair. I normally respond to say, well, that's you've made the choice to access the capital markets, whereas for the not-for-profit sector, remembering Australia is unique in applying these complicated standards down to this sector. And we were predicting, as Susan said, this season, the reporting season, June 2020, was going to be very, very complicated for this sector. The sector had 1 year's grace in applying the new revenue standard, AASB 15 and 1058, but they had to then apply the standard at the same time as AASB 16. So this sector was already going to be overloaded with new standards. And just as I was preparing for, this is going to be a very difficult reporting season for everybody on this call, we've now overlaid it with COVID. And I almost think, this is for not-for-profits, this is definitely for most Australian companies. This could be one of the most challenging reporting seasons I've ever been through. And we've got significant risk for your directors, the auditors. How do you predict what's going to happen in a world that's so uncertain and changing so quickly? The accounting standards have never envisaged this sort of world we're living in, been able to have impairment, revenue ceasing, and the accounting standards don't change. And everybody's reporting requirements, whether it's through the Corporations Act, whether it's through the Charities Act, ANCNC, that nothing's changed. So we'll go through financial reporting. And as I've been preparing the slides, the first time ever when I've been doing a not-for-profit update, he's talking about going concern. And it's just so scary that when I'm talking not-for-profits, he's actually going through the requirements of going concern and solvency. We've got the unique issue on impairment and fair valuing certain of your assets, what provisions you should make, and how do you account for government support? Are you modifying certain arrangements with governments, etc.? So we're going to break it down into two sessions. So this morning's session will deal with COVID reporting on your and these issues on preparing your 2020 financial report, and Susan will take us through a 30,000 feet view of AASB 16. So looking at, if anybody's not read the newspapers, been out in the street, or has been socially isolating before COVID, everything starts on March 2020. And for anybody that's not lodged their December financial statements, that date is key. So this is a non-adjusting post-balance sheet event for a December year end, but obviously anybody that's preparing a set of June financials, we are dealing with and have to report as at the 30th of June 2020, even though we don't possibly know what the future is going to look like, and the future, what will we look like by December 2020. Looking at people in this room, going concern, and there are a number of people, have you got access to funding? If your key fundraising events were charity rides, charity dinners, and social distancing means you can't do those things, are you a going concern? Not being able to operate, can you operate in the world we live with, social distancing and close down? Liquidity. What is your cash flow situation? How many people have you put on JobKeeper? And what is your judgment as we come to June 30th as to when or if the government will change JobKeeper? What will the government do in 2020? For a number of people on this call, you do have trade receivables. You do actually provide services in order to keep yourself going. Have you got bad debts? A lot of people on this room in this call have got leases. Are you able to pay your rent? Has your landlord given you a lease holiday? Are you retrenching staff, furlonging staff, or planning to retrench staff? So very, very difficult times. And there are issues in terms of even doing your audit. Are you going to be able to let your auditors on site? Do you want your auditors on site? Obviously, the world has changed. The world changed very quickly. You're now adapting to a working from home environment. Has that actually caused weakened internal control? And are the auditors going to have to document different internal controls, different aspects of your financial reporting? We've got impairment. And although we're talking to a not-for-profit, you may well have assets that are not recoverable, assets that you're not using anymore, assets that you may never use anymore. And the new terminology that creates this double whammy for this audience, the new leasing standard, as Susan will deal with, actually introduces the concept of a right of use asset, the ROU. So we no longer have a concept of onerous lease provisions, but we do have an impairment issue on the assets. So as from the 1st of July 2019, you will have recognized a right of use asset for most of your leases. If you're no longer going to use that lease, then it comes underneath the heading of impaired. Looking at the not-for-profit sector, you can't provide services, you can't get funds. Some of you will be sitting there on quite large shares, endowment type of arrangements. Have they fallen? Have you put your operation in hibernation? How is the government supporting you? So all of these are major issues. And absolutely, and we'll deal with this a lot, and I strongly recommend people on this call to read this joint publication, which only came out last week. So the Australian Accounting Standards Board, the AASB, and the Australian Auditing Standards Board, the AASB, issued this joint publication to how directors and auditors should deal with this. And these are the main headings from that paper. And it starts with solvency and going concern, how to deal with going concern, how do you disclose going concern, what do you do if you're not a going concern, and again, the various impacts on this sector. Sports clubs, you've not been able to operate for 2 months. Are you refunding people's subscriptions, donations? Performing arts. There are no performing arts. There are no ballets running at the moment. When will you be able to fulfill your function? Schools and education. What are you doing with your foreign students? What are you doing with the borders? Are you planning reductions in fees? Fundraising. All the major fundraising has been cancelled. The London Marathon's cancelled. The etc. Major dinners. I think I was supposed to attend 3 charity dinners in the last 6 weeks that have all been cancelled. Some of you are dependent on retail, that you do have shops, you do raise funds from the high street. The high street's dead. Can you do research? Are the universities working? Can you fulfill your grant obligations? So an amazingly challenging time for this sector. So Susan, do you want to run that poll, please?
So I've just launched this poll, and this is really finding out for the people on the call how your business operation has been impacted by COVID-19. And if we can get the results of that, that would be really interesting to see, because often the business impacts, if you have significant business impacts, it's likely you'll have significant disclosure impacts as well. I think we're very fortunate that the AASB and the Auditing Standards Board actually issued that paper. It is a well-written paper, and it really does highlight the issues that will be faced. And particularly, you know, at BDO, we're auditors, and, you know, just getting access to businesses is going to be quite tricky if we can't get into your offices, you know, and actually getting sufficient and appropriate audit evidence is always a challenge for auditors. So, you know, it's interesting to see the guidance that has come through, and, you know, it's likely we will see more qualifications, whether it be around going concern or emphasis as a matter around going concern in the current environment, because it's just so hard to definitively say whether or not businesses will be able to continue for that ongoing period. Wayne, we've had 75% of people vote, so we'll just leave it open for a little bit, but the results are not surprising, but really everyone is saying predominantly they've either been significantly impacted or to a minor extent.
And when you flash the results up on the screen, they don't quite correlate to the first poll.
No, they don't. They don't correlate to the first poll. And I would say if you said significantly, but you weren't sure whether you were having disclosure impacts, I think perhaps what we're going to discuss in the next bit will really help people see where they need to make their disclosure and to what extent they need to amend their financial statements. Because I think a lot of people, you know, you come to a new financial year and you get last year's accounts and you just update them for the changes. And often people just look at, well, what's the new accounting standards? And so for, you know, people in government and not for profit, you're going to say, well, we've got AASB 16, AASB 15, AASB 1058, let's put those disclosures in. But there is really, given this uncertainty and the significant impact on your business environment, anyone who said 59%, I would think there's going to be other disclosures that need to be made.
And it's also quite telling that those people that it's too early to say, it's a significantly lower number than the people that responded too early to say in terms of, is it going to impact the financial report? And, you know, June 30th is only a month away.
Yeah, well, I'll close the poll and you can tell us about the financial reporting considerations.
Okay, so as I said, we'll break this session. The update is broken into today and tomorrow. I will predominantly just be miserable and talk about going concern and impairment, and then Susan will put salt into the wounds and just give you an overview of AASB 16. Again, emphasizing the validity of this paper, joint AASB paper, going concern and impairment. And a key issue, everybody has to make a decision as to whether you are a going concern. And the accounting standards are just hinged on the idea that they only apply if you are a going concern. And you've got to consider all available information. Are you going to be in existence, fulfilling your purpose in 12 months' time from the date of actually signing your financial statements? This is a direct extract out of the AASB publication. The going concern assumption is a fundamental principle. An entity, and whether for profit, prepares its financial statements on a going basis unless management either intends to liquidate or has no realistic alternative but to do so. So the challenges the accountants on this call are, but particularly the boards, are you going to be able to be functioning in 12 months' time? When you'll lodge your reports in September, October 2020, will you still be in business in September 2021? So directors, if you're preparing accounts on the Corporations Act, directors must satisfy themselves that it is appropriate to prepare a going concern. What is the uncertainty as to the going concern? And as Susan will deal with later, a lot of this is disclosing the judgments you've made. Who are your stakeholders? Are you looking for funds? Have you got endowments? Have you got students? Have you got patrons that will be looking to read your financial statements in order to understand whether you'll be able to continue as a going concern? Optimism is not the way to approach this. It's realism, and then disclosing the realism and the judgments that you've made around that realism. What is the likelihood of business returning as normal? What are your assumptions that lockdown will finish? What is your assumption about whether there's going to be a second wave or a third wave? Potentially, what is your assumptions as when the borders open, when foreign students are allowed in, when theatres are allowed to open up? What degree will you be able to have the next big fundraising? When will the next time any of us be at a major ball? Can you imagine, can we have fundraising balls in social distancing? And even if we can, how many of your patrons will be comfortable in attending such events? And an equally miserable one, will a number of your patrons be unable to afford to attend such events? The going concern, so sources of assumed liquidity cash flows. I assume everybody on this call has been modeling out their cash flows. How much reserves have you got? What are your outgoings? are you a going concern? Are you solvent? And when will you not be solvent? What in your cash flows, what are your assumptions as to how long we're going to be in lockdown? How long is this disruption going to happen? I know I've looked at some cash flow forecasts that are wonderfully realistic up until December, and then amazingly optimistic when we get to January. I spend a lot of time, unfortunately, on international calls debating how you account for this. I also spend, as a miserable hobby, quite a lot of calls listening to economic webinars, and whether we're going to come out of this as a V, whether we're going to come out of this as a U, whether it's going to come out of this as a tick. And the one I was reading more recently was whether we're going to be a step coming out of it, that certain industries, certain sectors will come out of it, but others will stay depressed for a long time. Again, these are deliberate extracts out of the AASB publication because it interlinks going concern and solvency. So the Charities Act says a charity cannot operate whilst insolvent. So your directors, you have to be very, very comfortable that they're solvent. And obviously it's the accountants that are going to provide them the information, the models, to say yes or not. If any of you are still registered as companies limited by guarantee, you're governed by the Corporations Act. And there have been modifications to the Corporations Act that you can actually, now you've still got to have a director's statement of solvency, but you can qualify whether you are solvent. And for those people on the call that are incorporated associations, then you've got to refer to that specific legislation. But again, your directors, your office holders need to exercise reasonable care, skill and diligence in maintaining that you're solvent, that you're not incurring debts that you can't pay. And that will include obviously your rent, your leases, any employees, any payments for supplies. So it's an ongoing duty. In terms of those people making a director's statement under the Corporations Act, the directors have reasonable grounds to believe the entity will be able to pay its debts. It's one option. They can say that there is material uncertainty as to whether it will be able to pay its debts. And the third one, which again is horrible to actually present to this audience, the directors do not have reasonable grounds to believe the entity will be able to pay its debts and when they come due. And that is the honest declaration your directors can make. They actually do have very serious linking consequences when you come to the going concern, that if you've made that declaration at the bottom, you do not have reasonable grounds to believe you're a going concern. At the same time, can you justify preparing your financial statements on a going concern basis? ACNC requires registered charities to assess solvency and provide a declaration in the same manner as described for profit entities. So you need to make that declaration. And looking at your obligations, have you been able to satisfy your grants? Have you've been given monies by government to perform a certain function and you can't do it because of lockdown? You haven't got access to volunteer services. Again, you've lost your fundraising, you're having trouble raising funds. And is government reorganising and changing the way it's going to focus funds, etc.? Issues on the not-for-profit sector. You will have been given grants that you're not performing. And are your donors willing to say you don't have to return the money? I know you've not fulfilled this particular function. I know you've not done this research. I know that you've not done a ballet tour, etc. But I'm not going to ask for it to be returned. Have you got that sign off from your donors, from government? And when we come to the questions in terms of how you apply 1058 tomorrow, is that in line with how you've accounted for these donations, determining whether they're under the scope of AASB 15 or 1058? So, Susan, have you had any questions on going concern?
No questions at all, Wayne. So I think you've done a comprehensive coverage of that, but impairment of assets is always an interesting one and often creates questions there.
Okay, so again, looking at the sector, and remember this is a very challenging standard. AASB 136, IS 36 was not written for not-for-profits. It's fundamentally written for for-profits. An item is not generating the cash flows that you expected it to do. You therefore have to write it down to value in use or fair value less cost of disposal. There are special rules within AASB 136 that apply to not-for-profits. So, but it is still a very challenging time. So you've got your AASB 136. If you've got a triggering event, and most people on this call won't have goodwill or indefinite life intangibles, but if you've got property, plant and equipment, if you've got licenses, and again emphasizing now most of you will have these right of use assets, they all come under the scope of AASB 136, and you need to test these if there's been an indicator of impairment, significant changes with adverse effect in the entity have taken place, economic or legal. So with all those people that said they've been significantly impacted, 59% said they've been significantly impacted, most likely you've got an impairment trigger. Internal indicators of impairment, available from internal reporting that the economic performance status is or worse than expected. You're not using it, you're not able to use it. So that triggers the need to assess that for impairment. And then we're thrown into the unique not-for-profit paragraph in AASB 136, AUS 5.1. And for everybody on the call, remembering it's changed, so it's no longer depreciated replacement cost. We're now looking at fair value. You're now meant to look at the fair value of the asset you're not using. And again, anybody that's having to deal with fair value in this world of chaos, what is the fair value of something? Who will pay you for that asset? Do you actually intend to keep that asset? When we're out of lockdown, will you continue to use that asset? Will you continue to have that property, that operation? So amazingly challenging times for applying impairment in this sector. And if you have an impairment, you recognise an impairment loss. Another issue that people are getting on impairment, depending on which sector you are you actually owed money by people? Have you provided goods and services? Are you a school? Have some of your students, parents got into difficulty? Businesses got into difficulty? Are you providing for those receivables? And what is your model for now preparing for those receivables? You may get, when we get to 1058, at what point did you recognize a donation? Did you actually recognize a right to receive cash under 1058? And now you've got doubts whether that donor will be able to come good with their promises. Is that an issue under AASB 9? So those are the two clear issues on the challenges of COVID, I believe, in terms of AASB 101. Are you a going concern? And if you're not a going concern, how are you going to prepare your accounts? And how are you going to disclose those issues in terms of disclosure, going concern? And how are you going to deal with your impairment of assets? So over to you, Susan.
Well, just before we go into disclosure, I'm going to run a poll just to see, do you anticipate the following items will be a challenge for you in your 2020 financial report? And Wayne's talked about, the challenges of going concern, impairment of assets. Some entities may have debt. We're talking about schools. Some of them have got debts. Do you need to renegotiate? You don't anticipate any issues or have not considered it yet. So if you could answer the poll, if you think there's any issues or you don't think there's issues, that would be interesting to see. And I can see a few people have said going concern. They better not be in the government sector, because otherwise we're all in a lot of trouble. I'm sure they're not. So the votes are just coming through very, very quickly, so that's great. And these polling results are interesting. And not surprisingly, that's pretty low. It's coming through quite lowly on the renegotiation of debt, because in this sector, we're not expecting a lot of debt to be there. When we ran it for the for-profit sector, that was actually one of the ones where people thought were going to be issues for them. So I'll close the poll in a couple of seconds. We've had a good response. 71% of people have voted. And I'll close it now and share with you the results. So, Wayne, was this surprising to you? 18% going concern.
I don't think it's surprising. I find it amazing, depressing. We're used to working in the junior explorers, the startups. So you're used to seeing going concern. But I've never, with all my years of dealing with not-for-profits, etc., seen that type of response or expected that type of response. And even the impairment of assets, people out there are going to struggle, not being able to restart, not being able to properly use their equipment and properties.
And determining the fair value is going to be tough.
Absolutely, and this challenge, the auditing challenge, and I can't emphasize enough, as was correct with that paper, this is working with your auditors as quickly as possible. And there is this decision of when are you going to lodge your accounts? When do you actually intend to report? Are we of the belief things will get better, things will become more certain, or the other way around? And where are you going to get those valuations from? And how do you satisfy yourself that your asset is fairly valued? And then if you can satisfy yourself and your boards, can you get the auditor over the line?
Well, I will move on to disclosure now. And really, people in these uncertain times, so I'll go back to the standards that we're looking at. These standards are financial reporting standards that you might not have thought about for a while, but given the uncertainty, the issues that people are saying about going concern and impairment of assets, we need to revisit these standards. So you can't just update your accounts for the new standards that we've got on the horizon, but also looking at what you need to change in relation to some of the old standards. And AASB 101, this one deals with going concern. So paragraphs 25 and 26 deal with going concern and disclosure of significant uncertainties as to whether the entity will continue as a going concern. Paragraphs 122 deals with the key judgments apart from those involving estimations, and also disclosure about assumptions. So significant judgments and estimations that you have made in your financial statements. So if you're a sporting organisation, what are the assumptions you've made about whether you need to close down for COVID? Is there a second wave? They're the sort of judgments that you've had to put into there. And these disclosures are important because in this environment, you have major sources of estimation uncertainty at the end of the reporting period, and there will be significant risk of material adjustment. AASB 108 deals with changes in estimates, and concepts of estimation uncertainty are nothing new, but this year the process is far more challenging. Judgment's essential based on the latest available reliable information, and those judgments need to be disclosed. So these are the paragraphs in the standard that I would refer you to and have a look at and say, do I need to make some changes to my financial statements this reporting period to deal with these requirements? Wayne gave us a big lesson on impairment of assets. So when we look at impairment assets, you should be considering what are the different scenarios and probabilities of those scenarios arising when you're doing your discounted cash flow projections. In this environment, it's very hard to meet the fair value less cost of sales impairment test. So most people will be doing discounted cash flow value in use calculations. And where you do a value in use calculation, you will have to disclose reasonable possible changes in a key assumption. So this is your sensitivity analysis disclosure of where you're making judgments about what the future will hold and what percentage changes in those relationship to those key assumptions, what impact that will be. And for the for-profit sector, this is really a key focus area of ASIC. And I think really this is one of the areas that even in the not-for-profit sector, you want to be giving enough information so users get a good understanding of your financial statements in this environment. AASB 7 is financial instrument disclosure, and this is where you need to disclose issues about your credit, liquidity, and market risk. And for many people in this sector, liquidity risk is one of the key areas, and credit risk. When we look at the government, the credit risk of trade receivables for a lot of government entities really will have increased. There will be financial distress, and whether utilities can collect the money that they normally would, is definitely going to be compromised. And yet they're still providing the services because there's an expectation that the government is going to be much more forgiving in the current environment. And onerous contracts and insurance recoveries. And this is one that, has impacted us at BDO. We've booked conferences expecting to hold them. And then with the coronavirus, we've had to cancel the conference. And so the cost of the conference then becomes recognised as a liability at the time of the cancellation. It's an onerous contract. Now, we may have an insurance recovery that we can recognise, but in order to recognise a receivable for an insurance recovery, it has to meet a virtual certainty test. And so you have to be very clear that your insurer will actually pay up. They're not going to dispute the amount. So you may get a mismatch between the related costs or losses suffered and the recovery of the amounts. Because if you think there's going to be a dispute with the insurer, that they're going to say, no, this was a pre-existing condition, then you might not meet that virtual certainty test. So I have 10 minutes to talk about leases, and this is a subject, a very big and comprehensive standard. The reason that we've devoted such a short amount of time to it really is because we've got a number of online webinars that you can listen to, and we've also running masterclasses. So hopefully you've already adopted and know the key changes arising from the leasing standard. If not, there is a wealth of material and presentations that we've got available for you all on the BDO Australia website, and there's even a key topic, leases. But just at Wayne said I was going to do 30,000 feet. I think it's more like about 50,000 feet. The main change to practice for lessees is no more operating leases, no more straight line expense. So this one is causing a mismatch between what your cash outflows are in your rental expense, because in the early years you're going to have a higher expense relating to the financing lease charge, and then you'll have it being lesser as the lease period goes on. We all had to transition effective either 1 July 2019, or if you did the full retrospective method, 2018. And now in the current environment, you've got to consider, well, have those opening balances that I recognise changed because of has there been lease modifications? And that's actually something that's very much an issue in this COVID environment. But just the basic requirements of the standard mean that your earnings, you'll have higher EBITDA because your rental expense is coming out of operating costs, and you've got a depreciation, which is your depreciation of your right of use asset, and an interest expense. Statement of financial performance, you've got this right of use asset on your balance sheet, but then that means you've got potential impairment of that right of use asset. You've got higher debt because of your lease liability, and it worsens your current asset position because the right of use asset is classified as a non-current asset, and the liability, your lease liability, the financing element, is split between current lease payments and non-current lease payments. Cash flow statements, you've got higher operating cash flows because the rental expense that you previously had in there is now being put into financing charges, or either potentially investing with your asset. And bank covenants, if you do have bank covenants, they might be impacted. The biggest change for this sector is really the systems change. And we've looked at some clients, particularly in the health sector. We've been doing a lot of work with health, and they may have hundreds of leases. So actually having the systems and processes for that is actually been a major issue on adoption. And I think we'll see that probably more in the government sector than the smaller charities. So the definition of a lease is the customer controls the use of the asset. A service is where the supplier controls the use of the asset. And in the determining whether you have a lease, you have to look, is there a right to use an asset, right to control the use of an asset? So the first step is there an identified asset? And sometimes even in service contracts, yes, there is an identified asset. If I've got a school bus and I'm getting a transportation service provided to me, but there is a bus. Does the lessee obtain the economic benefits from it? Well, yes, I'm getting the use of the bus. And then, but do I have the sole benefits of the bus? And if that bus has been spray painted with my school's name and, it can only be used for me, then I have got sole use. If it's just a normal bus and it can be used on all different functions by the transportation company, then the lessee's not obtaining the economic benefits. And does the lessee have the right to direct the use? If I have the bus and I'm telling the bus where it must take for students, then yes, I have the right to direct the use. So I might have a service contract to provide transportation, but it could actually have an embedded lease in that service contract. There is a recognition exemption, the short-term leases, so lease term of 12 months or less. But if you have extension terms, you need to include those. And if you need to include reasonably certain options to terminate or extend the lease. Low value leases is where the standard doesn't specifically specify what is a low value lease, but a low value lease generally is determined around the US $5,000 mark when new. And this low value isn't based on the materiality of the entity. So, if you're government treasury department, you've got the same low value lease test as a very small charity. It isn't dependent on your materiality. So that is an important point to make. Determining the lease liability is where we get into the calculations, and it's really around your fixed payments. Variable payments in the main are excluded. And that's why certain contracts which involve the lease of an asset, if all of the payments are totally variable, then actually the lease liability is relatively small. So these are the items to include in your lease liability calculation and things to think about. One of the key areas that I have been asked questions on is what discount rate to use, because the standard requires you to use the interest rate implicit in the lease. Now, anyone who's got a building property lease probably will go through that agreement in a lot of detail and find I have never seen a property lease specify what the interest rate is implicit in the lease. And in this case, then you have to look at, well, what would be the likely rate that has been put into it? And usually a starting point will be the lessee's incremental borrowing rate, risk adjusted for the risk associated with that particular asset. Now, when we look at very short-termish leases, so leases probably about 5 years or less, when you do the maths, there's not that much difference. It doesn't cause a material difference in terms of what discount rate you use. So you've actually got a bit more flexibility to not be quite so specific. But if you've got assets that you're leasing and you've got long-term leases, like, potentially you could have a lease up to 30 years, then in those instances, the discount rate that you're applying will be quite material and it will cause material adjustments. So with the not-for-profit sector, there was a deferral of the requirement to fair value peppercorn leases. And that was so welcome, because when we were talking to certain entities, they were going, we have no idea how to determine what the fair value is of our right of use asset, because these assets have got restrictions on their use. And so how do I determine that? I've been given a lease so that I can run a golf course in prime real estate. This land is worth millions of dollars, but I can only use it for this purpose. How do I determine what the fair value of that right of use is? And because of that, the AASB have decided to issue a temporary deferral option. And that deferral option will remain in place until guidance is available. The deferral of the requirement to fair value peppercorn leases is optional, but everyone I have spoken to that is in this situation is actually taking advantage of that option. And I think that's a very wise thing to do. So at the moment, you just measure your right of use asset at the present value of payments, the payments that you have to make. So usually that's quite an insignificant amount, but it really does depend on the entity. And then you just provide disclosure to enable users to understand the effects of the peppercorn lease on your financial performance. So we have done this very 50,000 feet look at AASB 16, but you should have transitioned, and one of the key areas to make sure is that you've identified the full population of leases that have been identified. Most people, I know government sector is using the modified retrospective method for transition to the standard. That is definitely the simplest method, and it is adopting it from 1 July 2019, not going back full retrospective and adjusting your comparatives. There are practical expedients on transition, and if you've used the short-term or low-value lease exemptions, then you have to disclose what those were and what the expenses were in relation to those amounts. And for those people who have got many leases, and this is probably in the government sector, but some of the very large not-for-profits, actually getting the systems and processes dealing with your leases, it has been probably one of the biggest challenges on adoption of this standard, and caused a lot of work to create those asset registers and lease liability registers. So COVID-19, many people probably have had modifications to their leases. They've been given concessions because actually they haven't been able to occupy their premises. And when that's happened, that normally would be a lease modification. But the International Standards Board has issued guidance and temporary relief from accounting for it as a modification, because if you've had a modification, then you need to remeasure your lease. But in this situation, if you've had the situation that either your lease payments have either been deferred or lowered, then that doesn't have to be treated as a modification to your lease. You can just recognise the lower amounts that have risen. So definitely have a look and see if you fall within that concession that's been given by the International Standards Board. Otherwise, if you're getting incentives provided by the government, whether they're government grants, also consider whether they're in the scope of AASB 120. So they're the sort of things to think about with payments that have been received. And I know in our most recent accounting news, which is available on our website, we've actually providing guidance about if you're receiving, JobKeeper job payments in relation to employees, and looking at some of the scenarios around the issues with these government incentives and provisions to keep people employed and support businesses at the moment. So tomorrow we will be looking at AASB 15 and AASB 1058. We've just done a very high level on COVID and the new standards. We haven't had questions come through, but I guess if there are any questions, if you could put them through. Wayne, did you have any closing comments that you wanted to make?
I almost apologise to the audience for the challenges and the problems here. I've been in this game a long time. I'm an accounting expert. And this is very hard. The accounting for some of these issues are very hard. Actually applying AASB 16 for the not-for-profit sector is difficult. Lease modifications are also very difficult. And people on this call and this sector, their role is to do that, support their organisations, support their charities, etc., not necessarily to become financial reporting experts. So I do apologise for this morning's session, and BDO has got the knowledge to help you. So that's my only comment. But you did very well, Susan, running through AASB 16 at such a high level. Well done.
Well, thank you everyone for joining us. And I did get one question, which is, will these slides be available afterwards? And definitely yes. The slides will be available. They'll be mailed to you. And I know for some people, they may have lost a bit of sound. Sometimes that happens with the internet connections that arise. Luckily, it didn't happen for too many of you. So we also have this pre-recorded. So if you did miss chunks of it and you want to listen to certain bits, you'll be able to access the webinar, but also access the slides. And we do have a lot of very good material online that deal with these issues. So if you have got leases and you haven't adopted it, there's still time to do that. But thank you so much for staying with us and being part of the session. And we look forward to catching up with you tomorrow. Bye-bye.